Okay. Hello, everyone. Thanks so much for joining this training. If I just wanted to check, can you hear me okay? Yep, I think everything's going all right. Sorry, just adding some additional people to the meeting. Okay, so we might just start right now. So I'll just commence with sharing my screen. Okay, so there we go. So thank you so much for joining this training. So we'll just go through some recent super changes and just common audit issues and how to address them. So we'll also cover auditor reporting and like how to prevent common audit issues. So just briefly a little bit about us. So Xsource is one of our clients, and we mainly do SMSF audits, but we also do some training and consulting work. Each year we co-write the SMSF auditors exam, and we do some prepare some audit training modules as well for the SMSF Association. And we're a team of 7, and 4 of us are registered auditors. Majority is located in Sydney. We also have an auditor in Brisbane and one in Melbourne. So stuff that's currently kind of topical in the SMSF space. So I guess one of the main things is really the Div 296 tax. It's not yet law, and they've ditched the initial proposal where unrealized capital gains would be taxed, and deferred the start date to the 1st of July 2026. So there will be a rate of 30% tax between 3 and 10 million balances, and that rate will increase to 40%. So that's new as well for balances over 10 million, and both the 3 and 10 million thresholds will be indexed. Now, it's still a little bit of a questionable proposal because like super funds, they'll be required to track and apportion realized capital gains at an individual member level. And the issue with that is really that they currently don't do that. Like their systems just don't allow them to do that. So also the large funds, let's say if you have your money with Australian Super, all investments are pools. You don't own like 100 CBA shares, for example. So it's going to create some challenges like administratively for all super funds, but also SMSF software providers and actuaries. And especially because there seems to be a little bit of, not that much time still to prepare. Now, in practical terms, there would need to be a cost-based reset, so similar to what we had in 2017, to make sure that it captures realized gains from that start date. So that basically means market valuations is going to be, I guess, a bit of a focus because, yeah, essentially there would be a cost-based reset date at the 30th of June. Now, the treasurer, Jim Chalmers, he had to revise the initial proposal that included unrealized capital gains because basically the prime minister just like probably realized that there were some issues with the existing proposal. But I think some people are in the industry are a little bit concerned that they don't really want to lose face, so they want to push ahead with this type of proposal, but it just seems to be that there's really some practical issues with the implementation. So for now, it's really like a wait and see until the details are issued. And I think we're quite lucky that there's organizations like the accounting bodies and also the SMSF Association. They've done lots of advocacy work, working with Treasury, and they're still working with them quite closely to just point out the practical issues and hopefully come to something that is both fair and practical. Now, things that you might see that financial advisors like strategies that they might be looking to implement is when non-concessional contributions come in, you can choose who to allocate them to. So we might see like more people maybe making spouse contributions. Another one would be the spouse splitting of concessional contributions. So any concessional contribution made to super, initially it always has to be allocated to the person that they're for, and they will count towards their cap. But there's the option to subsequently allocate 85%, so basically the full amount less the 15% tax that you pay on concessional contributions to their spouse. So the way it works, it's really like it's processed as an internal rollover. So you might see a little bit more of that at the end of the financial year, one person, they might want to, I guess, split or like transfer all contributions to their spouse just to work at equalizing member balances. Another thing is when people take more than the minimum pension, you do need to look at like who should the excess be allocated to, like what would make sense. And I guess we might just see more benefit payments being allocated to members with the highest balance to just equalize balances more. So that's probably what most advisors will sort of look at in terms of strategies, like how can you sort of make sure, like kind of monitoring and equalizing balances. And another one from an audit perspective and relevant for the accountant is really just there's probably going to be more scrutiny from the ATO on market valuations, which has already kind of been a thing for like the last few years. But it's just because most caps, like how much can you put in, how much do you need to take out, and also the tax concessions, they're simply linked to member balances. So that's probably something that will get a bit more of a focus, and maybe we'll see a little bit more detailed guidance. We'll go through market valuations for different assets in a little bit, specifically property and unlisted assets, like listed, unlisted shares and unit trust, because that's always just a little bit of a, like a contentious issue. Other issues or other things sort of on the ATO radar. So the ATO, they thought that auditors generally had a copy of the ATO trustee declaration on file. And then they realized that they actually didn't, which was basically because of the instructions that the ATO has on their website to auditors, because it didn't really specifically say that they would expect the auditor to always have a copy for whoever is a trustee at the time. So they've updated that wording. And essentially, they now want auditors to cite and have on file ATO trustee declarations for everyone that has been appointed as a trustee after 1 July 2007. Clearly, that can be like, most people, they might just not have it because it's been lost. Like if they've been appointed as a trustee in 2010 and maybe they've changed accountants once or twice, they might not have it on file. Like they should, but realistically speaking, clients, they might not always still have it. So essentially what we're doing currently as part of our audit process, which I think most auditors are doing, is just asking for a copy of the signed ATO trustee declaration. And if it's been lost, we'll ask people to execute a new one, including providing a declaration that basically says we've executed this in the past, but we're unable to locate the original. It's been misplaced, so we've executed a new copy. So that's just something to be aware of. And it might seem like a super trivial administrative thing where, you might feel like the ATO should have other maybe stuff on to worry about. But it just sort of comes about from like trustee accountability, because when the ATO pointed out to trustees that there's compliance issues, most of the time the response is like, oh, we didn't know. And I think they're just a little bit tired of the like trustees not knowing and just maybe saying, oh, my accountant didn't tell me that, my advisor didn't tell me that, and so on. I think they just want to put a little bit more like onus back on trustees in terms of responsibility and just being aware of those responsibilities. Now, separately, so this is a little bit in like random order, just things that are kind of topical currently with the ATO. So just moving on from trustee declarations to pensions. Now, most people would be aware if you don't meet the minimum pension, a pension ceases at the start of the year. And it was pretty common industry practice that if a pension wasn't met during the year, to just not claim ECPI and but assumed that the pension would continue the following year. So essentially, most people were under the impression that, yeah, the pension might cease for tax purposes, but you still have a pension contract in place. The ATO basically kind of clarify that that's not their interpretation. They're saying you have to document that the pension has been commuted, and you need to also document a new pension commencement. So you need to prepare new pension commencement documents. Now, some people already did that. I think maybe half did and half didn't. So they're just sort of clarifying that you really need to document your commutation and the recommencement. Um, I guess one thing to keep in mind is that the pension commencement value will always be different because it's going to be a year later, and you might have taxable, tax-free balances mixed with accumulation. And you also need to consider that if you're not meeting the minimum pension, any withdrawals that were made, they wouldn't be considered pension payments, but they would be lump sums. And if a person hasn't met a full condition of release, that could potentially be like a breach of the benefit payment rules. Because if they're under 65 and still working, they might not have maybe they could take money out as a transition to retirement pension, but they can't take money out as lump sums. So that could possibly be or that would be like a breach of the benefit payment standards. Um, just as a side note, I do think one thing to keep in mind is that your responsibility as a tax agent or an accountant, they're different to the auditor. So when I was an accountant, I used to think like, oh, this fund went to the auditor, they checked everything, so it's all good. But the auditor, they check what they have to check, which is basically outlined in their engagement letter and in the audit report. So for example, like I'm not saying they're not checking pension documents, they should, but um like they're not checking like the quality of your document, they're just checking does it confirm like the type of pension, condition of release, and so on. But like let's say if maybe the template that you're using doesn't include the option to have a reversionary beneficiary, which might be a good idea, they're not going to comment on that. So I do think it's just something to keep in mind that, especially when it comes to documentation, a lot of auditors, they will have something in their engagement letter that specifically says something along the lines of like, um, when it comes to legal documents, such as like trustees, change of trustee documents, trustees need to seek advice from the provider on how to execute them, and we're not responsible for them being executed correctly because they're legal documents. Now, obviously, like we do check them, but I think it's just one thing to keep in mind. So just also as an example, like the tax return is actually specifically excluded from the audit. So I would say the majority of auditors, they probably do not review the tax return because they don't have to. And some people say like, well, if you review it and you document that you've reviewed it, it's also your problem if there are issues. Now, clearly, the tax return is the only thing that goes to the ATO. So we do always look at it, but if we see anything that doesn't seem right, we pass it on to our clients just as an FYI. So we just specifically put like, hey, just so you know, the tax return says this, but it looks like, XYZ. But yeah, I think that's just something to keep in mind that, the accountant and the auditor and the tax agent, they've got different responsibilities. And it would be worth it, I think, to just sit down with your auditor and just go through like specifically what they check and what they don't check, and also what their materiality thresholds are. I'm sorry, but that's just like a little bit of a like a side note, just in terms of documentation. I do think you need to make sure that wherever you source your documentation from, that they also sort of provide instructions on like how to complete it. Just separately, I think that the ATO's been mentioning like a fair bit, like lately, just with property and leases. Basically, they're saying they want properties to be subject to a lease and trustees to actually have like a written lease in place. Now, often, like sometimes we find when we ask people for a lease, they say like, oh, if you look at the legal definition of a lease, it actually says it can be binding when it's just verbal. And yeah, that might be true. So you could have a verbal arrangement. And it could be like, enforceable. But the thing is, if you haven't documented, it's really difficult to check for anyone. So the ATO, they're basically saying they expect funds that own property, so it could be directly or perhaps in a related unit trust, to just have a lease in place. And specifically for commercial property, it's important if it's leased to a related party because you probably be aware that the in-house asset rules will say that any asset leased to a related party is considered an in-house asset, and there's a 5% limit on in-house asset rules. So it specifically says that excludes commercial property, if it's leased to a related party and subject to like a legally enforceable lease. So if you don't have a written lease, that's quite difficult to confirm. So there could be, you could potentially have an issue, or there's a risk with the in-house asset rules. We do find with commercial property, usually it's not an issue for people to have a lease, because if the tenant's unrelated, most of the time people would have a lease. If it's between a related party, it's really not that hard to put a lease in place. It also doesn't necessarily mean you need to go see a lawyer and pay a lot of money for a lease. Um, like basically, like in theory, trustees could possibly just draft up a lease themselves. We're not saying that they should, but essentially you just need something that is documented that confirms the terms. And yeah, I think one of the main reasons is the ATO, they just want to clearly have the parties identified to confirm if it's related, a related tenant or not. Now, even though I guess you can't really tell necessarily from the surname, like something could be leased to a family member that just happens to have a different surname, but it's just the combination of evidence, including representations made by the trustees that it's not leased to a related party, which will most of the time be covered by the rep letter or a separate declaration. It's just like everything all together would support to the ATO that it's like a commercial arrangement. Now, just for residential property, I think that's a bit more of an issue because let's say if the fund purchased a residential property in 2018 and they're using a real estate agent, most likely there was a lease that just covers the first year. So that's for maybe 2018, and it might say it's rolling over on a year by year basis after that, but you don't really have any documentation to say that. So in that case, what we're just asking for is ideally a copy of the original lease, and then separately to that, just like a written declaration from the trustees, just confirming that the lease is just rolling over on a year-by-year basis and that there's been no change in tenant. So that's probably one way you can cover it with residential property where the lease is, it might be misplaced or maybe it was executed like 10, 20 years ago. Alternatively, it could also be maybe just like an email or correspondence from the real estate agent that the property is subject to the lease and just outlining the details. So that's just one thing to keep in mind, that the ATO just seems to be pretty big on having a lease on file, just also to confirm like the completion of income. So just to make sure that whatever the fund gets is like aligns with what's in the lease and any sort of increases that have been documented. Separately, just very different topic, just on custodian platforms and wraps. So I think you need to make sure that you're aware of this as if you have clients in custodian platforms. So for example, like, Hub24, BT Wrap, but also crypto ones. So let's say like CoinStash or CoinSpot, because they're also like custodian structures. And I would say probably about 60% of our clients fall in that category, that they have some sort of investments that is held through like a custodial structure. So the issue is basically that the accounting standards, they say, and the audit standards, that just a statement on their own is not considered sufficient appropriate evidence. Now, that's not really a new thing, and most auditors, they wouldn't just rely on a statement. So I used to think when I was an accountant that the auditor would just they just match what's in the financials to a statement and just go, okay, tick, 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 done. But basically, they need to consider like fraud. And you'd all be aware of like the Melissa Caddick case where ComSec statements and bank statements were fudged. And also ComSec portfolios and any like broker portfolios, they will specifically say to not rely on them. So they'll all have a disclaimer that says, we've done our best to make sure the information's accurate, but we're not responsible if there's any issues. So generally with every single investment, the auditor, they always need to do like sometimes it's referred to as like substantive testing procedures to confirm that the asset actually exists. Most of the time that's pretty easy. So for listed shares, you can just check with the registry. Like if you have the HIN or the SRN, we need to get a registry search to confirm like existence and ownership. With bank accounts, like technically you could get a bank confirmation. Most auditors probably don't get bank confirmations unless there's a really significant balance in a cash account and there's very little transactions. But most of the time, they will just audit individual transactions that occur on the bank account. So that could just be like buys and sells and stuff. So generally, listed shares, cash at bank, also property, you can just get a title search. Also with managed funds, like if someone owns maybe 1,000 units, they should get X amount as a cash dividend paid into their bank account. So if that's the case, that kind of supports they actually have those units. So normally in their audit file, auditors just need to note something down on how they've confirmed the investment exists. Now, the issue with platforms is that you can't really do any of those things. Like you cannot directly confirm ownership. And also the audit standards, they specifically say that just because you have an investor statement and like an audit report for the platform, so like a GS007 report, they're basically saying that those two things on their own, they're not sufficient to support existence and valuation. So the issue is basically that the fund doesn't own these assets directly. So there's a specific audit standard that just talks about all the stuff in relation to custodian platforms that the auditor is supposed to be checking and documenting. So basically, and as like when something is custodially held, you don't have direct ownership. So the SMSF is just the beneficial owner. So technically, if the platform goes bust, the SMSF could lose its assets, and you also cannot really verify ownership directly because there's no HIN. Now they're saying that the audit reports, they cover the internal controls of those platforms, but not the individual investor statements. And I know the systems produce the reports, but basically the audit report generally just covers only the systems, not the reports. And then separately, they're basically saying that a direct confirmation from the platform itself is merely just a statement of what's reflected in their record and also not sufficient. Now, you can probably say, look, that's a bit questionable because if the issue is existence, if I have a client with 20 million in a custodian platform and I reach out to them and I get a confirmation that says yes, these are their holdings at 30 June, I feel kind of comfortable that they actually have those assets. Also, if they're on a data feed. Separately, the audit standards basically say data feeds is not an audit procedure. So it kind of helps to make you feel better, but on its own, it's not something that you can rely on. It just means like you can reduce your testing, but you can't like get rid of it altogether. So specifically what the audit standards on platforms say is that what the auditor should be doing is they give like 3 or 4 options. So one of them is like they need to actually audit the records of the custodian. So that basically means their internal records to confirm that what they say that they own, they actually own. So that's never going to happen. So basically no SMSF auditor is going to go to Hub 24 and just say, hey, just show me that you actually own that. So that's kind of just unrealistic. So then they say that you can do substantive testing, and that's kind of explained as like you can maybe test transactions in and out of the platform. So perhaps if a member makes a contribution, takes a pension payment from there, check it against their personal bank statements. Now, most auditors are not going to ask for the personal bank statements of the trustees. What you can check potentially is transfers out of a wrap to like a non-wrap account. So like a bank account that's not held by the platform. But most of the time, when people invest in a platform, like they have the whole fund invested in that platform or the majority. So the thing is, this is just like a bit of a contentious issue with like what auditors are supposed to be doing and which doesn't really align with what the audit standards say. So the audit standards, they actually haven't changed, but it just seems like nobody was really paying that much attention to them until like a few years ago, where I think some people were like, hey, so what's been common practice in the industry is to just accept platform statements and a GS007 report, and that's it. But if you look at the audit standards, it actually says that that's not enough. So it's been kind of like a contentious thing, and I think it's something you do need to be aware of because your auditor might raise it with you, or they might soon, and the ATO is also likely to provide some more guidance on it. Because the issue is really like technically like ownership, and then if you can't confirm ownership, some people say you might also not be able to confirm valuation if you don't know that the fund owns it. Now, currently the guidance provided by the ATO is, I think it's really, really vague. So it is just not really clear to anyone. So, or, well, that's not really true, but it's just like the guidance that's provided so far. If an auditor passes that on to a trustee or accountant, it's just like, it's not really going to help them with explaining sort of what the actual issue are. So these three sentences or paragraphs is really the only thing that the ATO currently has on their website. And they're basically saying, if you've concluded that you cannot find that there's not appropriate evidence for ownership and existence for platforms, you can choose to qualify Part A and B, but not lodge an ACR. So they're just saying specifically like the part in bold, if you're qualifying Part A for valuation and existence, and therefore you're qualifying Part B, because that also covers valuation, because you can't get sufficient evidence for like the rights and obligations for assets held by a platform, you can choose not to lodge an ACR. So that is a little bit vague because actually what the auditor's contravention report instructions also say is generally if there's a Part B qualification, you have to issue an ACR. So there's actually specifically materiality thresholds that are set for that. So currently, what a lot of auditors are doing, like some of them are qualifying Part A only, some of them are not doing anything and they're just waiting for further guidance from the ATO. Some of them are qualifying Part A and Part B, not lodging an ACR. Some are including an emphasis of matter, which is basically not a qualification, but it's just sort of flagging like, hey, I've relied on the statements provided, but there's a risk that the financial statements are materially misstated. So separately, I think a lot of auditors also reached out to the accounting bodies to get more clarification, and they issued an FAQ in September 23. And there's one question that says, isn't GS007 audit report like sufficient on its own? And they're basically saying no. So this FAQ, it doesn't really provide too much guidance on what you should be doing, but it does say like what's not enough. So look, I just think that's something to keep in mind because I know some auditors, they've changed their procedures. Some of them are still kind of trying to figure it out, and some of them are waiting for clear guidance from the ATO. I don't think it's super high on the ATO's radar. They're kind of sort of pushing it back to auditors, just saying like, well, it's your job to just read the audit standards and then apply your professional judgment. But the issue currently is that the information that is on the ATO website is just, it's not very clear. And the reality is it's quite difficult to explain if there's not proper or if there's not like very specific guidance from the ATO. And another issue is like obviously trustees, they don't really like qualified audit reports because they don't really know what it means. And they think it's like always bad. And separately with financial advisors, they might have recommended a client invest in a platform. And they might assume that it looks bad on them if the audit is qualified, because which is not the case. But so yeah, it's just something to be aware of that the ATO, like the industry is basically hoping that the ATO will provide clearer guidance on this topic. And I just wanted to highlight that it's like a thing that is getting a fair bit more of attention at the moment. And yeah, I think something for you to be aware of that likely there's going to be some more guidance on that. And I would say that that guidance is probably going to say that the audit should be qualified. So that basically leaves a job, I think, for you to explain the type of qualification and why it's qualified. And currently, I think with the guidance that's there, it is a little bit difficult to do that because it's very technical and it's not all that clear. So yeah, just I think just something to be aware of and probably discuss with your auditor. So just in terms of qualifications and reporting, we'll just go through that now. Like, what did the different qualifications actually mean? Because I find sometimes trustees, they're confused about the difference between Part A and Part B, and what are the consequences? Like, is it bad? Am I going to be in trouble? Do I have to do something? Part A qualifications. So the audit report is basically split up in two parts. So part A, the financial audits, which is really the number side of things, and part B, the compliance audit, which is the table at the end of the audit report that just lists like the different CIS and CIS regulation sections that the auditor is supposed to check. Now, the Part A financial audit, like materiality for that is usually quite high. So most auditors will set it between 5 and 10% of fund assets. So if you have a fund that's 20 million, materiality is really quite high. So you could have like a $50,000 trust distribution that's double counted, and it's not an issue because it's considered like below materiality threshold for Part A. Like it doesn't result in a qualification. Like separately, the auditor is still supposed to like communicate, certain like misstatements, but generally Part A qualification and materiality is quite high, but it would normally anything platform related would be material for Part A because it's likely going to be more than 5 or 10% of fund assets. Part A qualifications, they're really more like an FYI to the trustees, and it just relates to the financial audit only. So a very common one is like when a new auditor takes over from an existing one, normally they will qualify the opening balance. So they will just basically say, I've not done a detailed audit on the opening balance because they're based on the prior year audit. So if there's a Part A opening balance qualification, the ATO, they've actually said they don't want to know about it. You do not have to indicate it in the tax return. It's really just sort of basically the current auditor saying we, we're not forming an opinion on the opening balances because we haven't done the prior year audit. So that's a very standard one. Separately could be platform assets, like what I've just discussed, like perhaps inability to confirm existence, but also maybe unaudited platforms or platforms that might be reported as a one-liner where you can't really do any testing of individual transactions. And another one would be market valuation. Generally, market valuation Part A would go hand in hand with Part B because generally materiality for Part B is like higher than Part A. I'd say the main thing to keep in mind with Part A qualifications, they do not get reported to the ATO. The auditor does not have to lodge an ACR. They're more like an FYI to the trustees. It's just generally when a trustee sees the word qualification, they kind of stress out because they think they have a compliance issue. That's not necessarily the case because qualification could just be inability to confirm something or just the auditor saying, I'm not forming an opinion on, this particular thing. So let's say opening balance or so on. So I would say Part A qualifications, not something to be concerned about. And the ATO, they've also specifically said that they wouldn't pick a fund for just to audit just because there's a Part A qualification. Separately, the Part B compliance audit. So that's basically all the compliance things. So like borrowing, stuff being in the right name, and so on. So the ATO, they set specific like reporting criteria for that, and the auditor has to lodge an ACR if any breach is over 5% of total assets or 30K, whichever is the lesser, or $2,000 for a newly established fund. Now that's all contraventions in total. So you cannot take, you can't, like a trustee cannot take out 2 times 15K as like a loan or a withdrawal and just say, oh, it's below $30,000. It's like the total of all contraventions combined. And basically, if it is over the mandatory reporting threshold, so those 3 bullet points, the auditor, they have to lodge an ACR. So it's not optional. They just they just have to basically. Now, Part B qualifications, so that's definitely, I would say, more of a concern than Part A qualifications, but I do find the ATO, they're quite reasonable and they look at the type of qualification and they will also look at whether or not it's rectified and they will definitely consider both of that when it comes to their actions. So generally, most of the time, the trustees are going to get a letter and it just generally says something along the lines of, you need to address your qualification. Only in some cases, it seems like they get sort of like a customized letter specific to their breach. And if it's like a significant breach, they might get a phone call from the ATO. But we find most of the time the ATO, they're really quite reasonable and they just want it fixed. Um, and there's some breaches that are just technical breaches. So let's say SuperStream, which is, a lot of the large funds, they just don't use it. They're supposed to, but if you ask them to do a rollover to an SMSF, chances are you can do that without using SuperStream. You're supposed to use SuperStream, but a lot of people still just don't do it. So technically, that's a reportable breach, and the auditor has to lodge a contravention to the ATO. But I would say at the moment, it doesn't seem to be something um, that the ATO is really concerned about, because it's at the moment it is still like a common breach. That doesn't mean it's fine not to use SuperStream, but I'd say that's like a far less sort of serious breach than a trustee in their 40s taking all the money um, out of Super and putting it in their offset account. So I do really find there's some breaches that are really more sort of like technical or administrative breaches, and then there's other ones that they just don't really like. So the ones that they don't really like, I would say specifically, is like younger members taking out money or lending money to themselves. Also, when trustees that are below preservation aids take out money and they report it in the financials as a loan, the ATO, they don't really see it as a loan, or they don't really treat it as a loan. They're just saying, okay, when you've taken out money, that's a member benefit payment. And when you put it back in, that should be a contribution. So you can report it as a loan if you want, but we don't really care about how you report it. That's just not how we see it. And we find most of the time trustees actually get an assessment in their personal name, where the ATO just consider it like a member benefit payment, and then they get taxed accordingly. So there's really like, I think it's worth, if there is an ACR, to just discuss with your auditor, like, is this a serious breach or not really? And the chances are, yeah, it's really like a mixed bag. And ideally, you just make sure that it's rectified. But I still find that the ATO is really quite reasonable, and they just mainly want things to be rectified. One thing that's important to be aware of, so we had on the prior slide, like when the auditor has to lodge an ACR, another one is repeat breaches. And that is also for immaterial breaches. And that's something I think a lot of people are not aware of. So let's say if a client accidentally takes out $500 just because they're using their own bank details or something, that's still, it's an immaterial breach. And any immaterial breaches, they have to be like communicated in the management letter. So essentially, for Part B compliance issues, there's no materiality in terms of the auditor having to let the trustee know. But if it's below the reporting threshold, it just means they need to let them know through the management letter. If it's above that, they have to qualify Part B and lodge an ACR. So if someone accidentally takes out $500, the auditor cannot go put in their, audit checklist, oh, that's immaterial, move on. They have to actually put it in the management letter. And then in the subsequent year, or just basically after that, if there's a repeat breach of the same, like of the same standard, it's reportable. So if the following year they only take like $20 by accident, it's actually mandatory for the auditor to report that. So that's just something to keep in mind. So normally in the management letter, it should say like something along the lines of like, please note, this is an immaterial breach, but I am required to report any repeat breaches after the issue date of this management letter, regardless of materiality to the ATO. So that's just something to be aware of, that if there is an immaterial breach, if it's like, if they breach the same standard again, even though it's for $10, which, seems like very trivial, but the auditor they're technically required to lodge an ACR. And I think that's basically just falls, like the ATO, they have this thing called the trustee behavior test, and they just don't want trustees, for example, to take out, maybe 10 grand one year, and then 5 grand next year, 10 grand the following year, just because it's, they might think, oh, it's below 30 grand, or it's just below the materiality threshold. So they just don't really, yeah, any kind of repeat breach is an ACR, just regardless of the value, because they just don't want people to sort of continue with like maybe, small compliance issues because they think they can. Yeah, probably the most common breaches that we see is just people accidentally transferring money out of the fund or accidentally into the fund, or putting things in the wrong name. Another one would be borrowing. So unfortunately, when there's like a bank overdraft, the ATO considers that a borrowing. So if your bank account goes into debit, perhaps because there's an insurance payment coming out that the trustees were not anticipating, that's technically also a breach. But I would say the most common one is probably market valuations. And we'll go through that in a little bit more detail because it's just people that have an SMSF, they invest in different kinds of assets. And, like unlisted assets, they just don't always have a market value that can be supported. Now, I do think the ATO, they're still really quite reasonable when it comes to breaches, and they're just mainly keen to make sure that they get addressed to some extent. Just in terms of so just make sure, I think the main thing is make sure that you have a read of the management letter because it will just point out potentially immaterial breaches that you should be aware of. Another thing to keep in mind is like, just because someone has done something by accident, that doesn't mean it's not reportable because people, they don't usually put their bank account in the wrong name intentionally, most breaches would be like non-intentional or like maybe accidental. So essentially, if someone's done something by accidentally, mixed up their bank accounts, normally it would still be like it's still a compliance issue. It might be an immaterial one that's not reportable, or maybe it's a material one. So just the whole reason, like, oh, we didn't know, or it was done by accident, um, they can be added to the ACR as mitigating circumstances, but they're not a reason for there to like not be an ACR because if something was done by accident, if that was a reason to not have a compliance breach, probably like, 99% of compliance breaches, trustees would say like, oh, I didn't know and it was done by error. So it's still always worth to, pass on like the circumstances for the ATO to know like why something happens, but it's just, I think just something to be aware of. Just because it's an error or, outside of your control or an accident, that doesn't mean it's technically not a breach and that, might still be reportable. Okay, so just moving on just to the different asset categories and like what you need for what. So I'd say the asset category that we probably get the most questions on is really property. Um, One of the things we have to do is annually is like do a title search to confirm ownership and existence at year end. So the ATO, they do expect auditors to get a title search like every year, either on 30 June or after, to just confirm ownership at that point in time. So just because the SMSF's getting rent on that's like not enough. So I just put on this slide like New South Wales is an exception. That's really just it's not an exception really, but it's more in New South Wales, you can do a free search that just shows you if there's been any changes made to the existing title search. So potentially with generally all other states, we would get a paid search and a whole new title search. Usually with property held in New South Wales, we can go to the titles office website and we can just, type in the details and it will show you the most recent edition number. So if that hasn't changed, we can document that the title hasn't changed. It could change, let's say, if a lease is registered, and then we don't know until we get a title search. But it just could be for New South Wales that, your auditor might not be, ordering a new one, but they're just checking if the details haven't changed. Separately, to confirm that the fund is the beneficial owner, the title search will always only have the name of the trustees. So that could be, John Smith or whatever. It's not going to have the superfund name. So in addition to the title search, they generally need something else. So if the title search shows an SMSF trustee company, that's a special purpose company, that's okay. But if it doesn't, you need something else. So that could be the contract of sale that might make reference to the trustees ATF, the SMSF name. Potentially, maybe at the time there was a declaration or acknowledgement of trust completed. You do need to be careful with declaration of trust because they can be dutiable events. So I wouldn't just draft one up. I would check with whoever looked after the purchase if there was one done at the time. And if you are getting a new one, I'd get that from a legal practitioner just in case there's a risk of double stamp duty. Other supporting evidence could potentially be like a settlement statement or maybe combination of like lease agreement or like land tax notice and stuff with the fund name. And if a property is held under a limited recourse borrowing structure, the custodian trustee sort of confirms the relationship. Now, I would say the most contentious thing is really kind of like market valuations for properties. Assets, really, all assets need to be valued at annually at market value. So it was sort of industry practice, I think, in the past to get that done every 3 years, but that was never really a thing. That was just sort of an industry standard. Now, um, just because you need to have a property valued at market value every year doesn't necessarily mean you need to purchase a property valuation each year at the end of the year. It just means you need to give your auditor something that confirms what the market value is. So that could be um, like sometimes we have funds where the audit's completed late. So let's say um, if we're getting, sometimes we're still getting 24 funds now. So if we have maybe like a 23 market valuation and a 25 market valuation, you could use both of those to do a trustee valuation and you can just extrapolate. So you could most likely use both of them and just work out the figure sort of around 30 June. So I think one thing is to just use multiple sources and do a trustee valuation. um, Sorry, I have a bit of a sore throat, so I'm just making sure I have a little bit of water every now and then. Um, but yeah, so I would say you can get with residential property, it's really easy because you can always get something online generally, and most of the time it's free, or it's very easy to find comparables. So the issue is mainly commercial property. So potentially, yes, you can get a valuation every year. There's more and more online valuation companies that have popped up, and the fees can be sometimes, $450 or something. I would say, like, you don't necessarily have to get a valuation from a registered value that's several $1,000s. It does depend on the type of property that you have. So we have one client, they have a petrol station that's huge in a remote area in WA. Most likely, I'm not quite sure because I haven't seen it yet, but I would say it's kind of likely that an automated online valuation for, $400 might not quite cover it or have an idea as to how much that's worth. So generally what this client does is they go to a formal valuer, but they don't go every year. They go like every other year, and then for the year in between, they do a trustee valuation and they just collect some like market data. So I would say, yeah, either get a valuation or just do a trustee valuation, but it just means the trustee's personal opinion is not a valuation. So essentially, the ATO or the auditor, they don't care about the trustee's opinion. They only care about the supporting evidence that supports that opinion. So just make sure that there's like some comparables or maybe like market data. So let's say if you have a commercial property in Sydney CBD and you have a proper evaluation for 30 and 24, what you could possibly do is maybe find like market data or just contact uh, a real estate agent, just say like, hey, what's the approximate increase in market value for commercial property in Sydney CBD from 30 June 24 to 30 June 25? And they might tell you like, oh, that's about 30%. So about 3%. So you could put that on file and then you could use the prior valuation and you can just add 3% and then document in a trustee valuation that they think the value is XYZ and it's based on, let's say, a June 24 valuation plus correspondence that you have a copy of from an agent that says the property market has gone up by approximately 3%. So they've added 3% to that value. So you don't necessarily have to get a new valuation annually. You can, or alternatively, it just means the trustees need to put in a little bit of work and just gather some supporting evidence. The ATO, they really do have a concern where market values for any kind of asset doesn't change from one year to the other. And they're basically saying that you need to have comprehensive evidence that the value hasn't changed. So they don't like it if, for example, um, if you get a valuation 31st of December and you use it for both years, what you could possibly do is maybe if the valuation has a range, potentially it might make sense to use the lower range for one year, slightly higher range for another year, or it just means you need you need some reasoning. And if you are using the same value, most likely your auditor would come back to you saying that it means you need additional evidence to support that it would make sense for both years. So it probably would make sense that you get like another source and that you just use that valuation, but don't just like use like the median value for both years. Because essentially they're saying if you have the same value for both years, you need very comprehensive evidence to support that that's appropriate. If you have only one valuation at the 31st of December, that's probably not quite it. So I would say in that cases, most likely do a trustee valuation and just maybe for 1 year, slightly higher range, subsequent year, like the lower range. Now, generally, what we use sort of as a guide with our clients is supporting evidence within 6 months of year end. That's not really like a black and white rule, but you need to give some sort of guidance, but we will still always get our own valuation. Like we will check if it makes sense. And if it doesn't, we'll go back and just say, look, it looks like based on information that we have on file, or it could be maybe the increase compared to the prior year absolutely doesn't make sense. Then we might just ask for additional evidence. But as a guide, we sort of say 5-6 months from year end. I know that the ATO, they verbally said in their SMSF auditor stakeholder group that they think within 3 months of year end is reasonable. It seems like so far they don't want to issue very prescriptive guidelines because it's just, I think with property, it's a little bit like, apples and oranges as well. Like you could have a fund with a $10 million commercial property, or you could have a fund with a $20,000 car park. So most likely the quality of the valuation you'd expect to be different. Like you expect it to be much more comprehensive for the larger commercial property versus the car park. And auditors, they would also always look at like historical information. So what have they been provided with in the past, and what has it been reported with in at like the prior year? But it's just something to keep in mind that their thinking is really sort of like 3 months from year end. But I would say just you would know which of your clients have property. So just identify those around year end and just make sure that at that point in time you start collecting some evidence, or you just let your client know that evaluation is required so that you can actually provide something that is around year end. But what it really comes down to is like either you get an annual valuation or you put in a little bit of work and collect multiple sources of evidence and have a trustee resolution just saying we think the value is X because, and then they just need to list reasoning and supporting evidence. Separately for income, we kind of covered this a little bit, that the ATO basically they really expect you to have a lease agreement on file, and also for that lease agreement to actually be followed. So for example, if I would rent a commercial office from a total stranger, it's pretty unlikely that they will let me use it for the whole year and allow me to only pay a year's worth of rent the last day of the financial year. So that's generally would not be considered, that's probably not going to happen. So auditors also don't expect for an SMSF to do that. So generally the ATO has also said like rent should be paid regularly and in advance. And that's whether or not the property is held like directly by the fund or perhaps indirectly through a related unit trust. So yeah, just mainly keep in mind, especially with related party tenants, that things just need to be on commercial terms, and generally it should be really clear to most people what that is. So just make sure that your client actually follows that. Just separately in relation to property, so banks don't really give loans anymore to borrow property within super. So most limited recourse borrowing arrangements, you'll use a non-bank lender. So generally linked to the loan, there will be an offset account, and they're not considered like bank deposits. So they're different types basically than banks held with like authorized deposit taking institutions. Now, the ATO, they've raised an issue several months ago that sometimes the terms and conditions of loan agreements from those non-bank lenders actually say that if you default on the loan, they can not only take possession of the property, but also any money that you actually have in linked offset accounts. Now, that's actually a compliance breach because under the borrowing rules, the lender can only ever have, recourse to the property itself, but no other super fund assets. So that's just something to be aware of, that's something that's getting more attention. So auditors, they're probably reading the loan agreements in more detail and just really checking what the arrangement is in terms of linked bank accounts to the loan. I would say if you have a client that has an existing LRBA with a non-bank lender or is setting up a new one, you should specifically ask them if they can place a charge over any linked bank accounts. And the the loan agreements, if it complies with the borrowing rules. Now, if you ask them that, they'll always come back to you saying, "Oh, our legal teams looked at it, and yes, it complies with all the super rules." And they'll probably still say that, even though the terms and conditions might literally say they can actually place a charge over linked bank accounts, which it's not really supposed to say. So I would just reach out to them and maybe make sure that you have something in writing and on file that confirms that it's their opinion that it is a complying borrowing arrangement. That's not really maybe going to help if it's not, but I would say that that's still, that definitely will show that the trustees have done all they can to confirm with the rules. So at the moment, most auditors, they're looking at the loan agreement and just pointing it out if it seems like there could be an issue with the links, offset accounts, and lenders having a potential charge over it. Another tricky one often can be like private companies or private trusts. So there's generally three types. So related, closely held, and widely held. And usually the audit evidence for these things, for these assets, they're different because they're simply just different risks associated with the different types of entities. For widely held ones, sometimes we get financial statements, but I would say more useful is actually just something issued by the company that specifically confirms the market value. Because the financial statements, they might not even talk about the market value sometimes. And the net asset value is not necessarily the market value. So if you think about accounting practices, the money that you have sitting in the bank there at 30 June is not the resale value of your accounting practice, like hopefully. It's based on your revenue, for example. So net asset value doesn't always like it's nice to have the financials so you can see how the company is doing, but it's not necessarily an accurate representation of the market value, just depending on what type of business it is. So now if you reach out to an entity and just say, hey, can you confirm the 30 June market value? If they're unlisted, most of the time they'll just say no, because we're not required to value our assets at market value, and we don't issue a formal market valuation. Now, I think it really depends on how you ask the question. So if you're most likely going to get a lot further if you just say, hey, if you contact them and say, I understand the company is not listed and the shares might not be widely traded, but I hold these in my super fund, so I need to report them at the approximate market value. So can you please provide some commentary on the approximate value just based on any, potential capital raisings or just like recent trades and just your knowledge of the company? And most likely you'll get a decent response then. It's just, they don't really want to be held responsible. So I do really think it depends on like how you raised a question. So yeah, that's just kind of something to keep in mind. And then for closely held entities, generally we would need a copy of the financial statement. So because most of the time closely held, it could be property development trusts, maybe like, 8 friends, unrelated parties come together and they set up a unit trust to develop some property. Not a related trust, but still a small number of people. So we'd normally need to actually look at what assets and liabilities that entity actually holds. So we will normally get a copy of the financial statement. Sometimes if it just holds property and a bank account, we can generally figure out the market value based on that if there's a property valuation. Alternatively, if it does other things, it might be just a written confirmation from the company, including reasoning, plus the financial statements. Now, separately with related entities, most of the time there will be a unit trust or a company that holds property and a bank account because an in-house asset is basically an investment leased to a related party or an investment like controlled by a related party. So normally that would be a unit trust or a company where the SMSF owns like, more than half or the majority of investments. And so for that, basically we just need a copy of the financials because we need to do sort of essentially like an audit of the entity itself. So it's kind of like a sort of like a look-through kind of provision, I guess you can call it. And we just need evidence of the existence of market valuation of all like assets and liabilities held by the entity. So that would be property valuations generally, and also bank statements. Now, the reason we need the bank statements is because an investment in a related trust, like it's only excluded from being an in-house asset if it pretty much doesn't do anything except for hold property and a bank account and doesn't have any borrowings or any loans. So we can't really confirm that if we don't have a full copy of the bank statements, because yeah, we would need to see if maybe there's loans being provided, or any debits on the account, and also if like rent is being actually paid like regularly. So if everything is maintained on commercial terms. And usually for the property, we pretty much need the same type of evidence as if the property is owned directly. So just because there's like a trust in between, it doesn't really make too much difference at all if it's related. We pretty much just need the same stuff. Now, just with cash, basically that's just considered a high risk asset from an audit perspective, because everything flows through the bank account. So most of the time, auditors still need all bank statements. It sometimes does depend on what software you use. So for example, Class, they have a data feed and they have an audit report for their data feed. So most of the time, auditors, they might only ask for maybe a year-end statement or just one bank statement to confirm ownership. Term deposits, main thing to keep in mind is that generally, they're material, and it is possible to add money to it or withdraw money from it. So if you have a term deposit that commences January 25 for $1 million, that's for like a year, so to January 26, normally your auditor, they'll actually need a 30 June statement or some sort of statement issued after year end, not just like, I guess, the purchase contract almost, because basically, it's no different to if you'd purchased like 1 million BHP shares in January, your auditor is not going to rely on the contract note for January. They're going to get a 30 June holding confirmation of those shares. So it's not really any different with term deposits. So just because maybe there's like potentially like a lower risk of things changing, that doesn't mean they don't need anything for year end, because most of the time term deposits would be material. So I know sometimes it's a little bit tricky, especially with some of the banks that issue very little documentation. But generally, just one thing to keep in mind for term deposits is that usually the auditor actually needs to confirm like existence, ownership, valuation, and so on at 30 June. So normally it means like maturity statement or just confirmation of the balance at year end. So yeah, we're kind of on the hour actually, just slightly over. So just probably in summary, when it comes to audit, I'd say just ask your auditor for a checklist of what they require for different investments, and just keep in mind that like what the accountant requires to process a transaction, it might be different from the supporting evidence that your auditor needs, because they just check different things basically. So they have to confirm, like in addition to it being recorded correctly, they also need to verify ownership, supporting evidence for existence, if it's recorded in the right year, if the transaction's complete, valuation, if it's classified correctly, and so on. And also just keep in mind that auditors, they can't use anything in editable format. So they can't use like Word documents or Excel files or, forward emails. Yeah, probably they're correct, but it's anyone can edit it, so it's just not something they can put on file, because if they get audited, they would get asked like, why would you rely on an Excel sheet? Because that has like, it has zero reliability basically from an audit perspective. So just, yeah, one thing to keep in mind, like that the type of evidence, it should be like not in editable format. Um, Now, if you have any questions, yeah, please, you can put them in the chat, or just, I know we've gone just slightly over time. Feel free to just reach out to me by email or phone, because we're always happy to help. I'll ask Xsource if they can forward everyone that attended a copy of the slides, so that you have the details and that you also have contact details in case if you have any questions. Um, okay. So I'm just going to have a brief look if there's anything in the chat. Yeah, will slides be shared to the attendees? Yes, they will. I think that's everything. or so far we don't have any other questions in the chat. So yeah, we'll distribute the slides. It has my email address as well. If you have any questions whatsoever, happy to have a brief phone call with you, or just just reply to you by email. Okay, so I hope this has been somewhat useful for you. And yeah, thank you so much for your time. And please reach out if you want to discuss anything further or like to clarify something. Thank you.